My name is Edward Tsang. This video gives a quick introduction to computational finance. What is it about? What can it do for us? What are the challenges? Suppose a trader has a winning strategy in the stock market. This strategy tells him when to buy and when to sell, and it makes him money reliably. What if another trader discovers the same strategy? Would they both make money? Well, they could, but if one trader buys in large quantity, price may go up. In that case, the other trader won't be able to buy at the same price. When that happens, the winner takes all. Who wins depends on who acts first when the strategy tells them to buy and sell. If trader A puts his trading strategy in a computer and lets the program buy and sell autonomously according to this strategy, then he could have an advantage over the other trader, for the simple reason that programs can react faster than human. Besides, programs don't have to eat and drink or sleep, so they can watch the market continuously. In order to put his trading strategy into a computer program, trader A must work with a programmer. That is, unless he can write programs himself, in which case he doesn't have to share his trading secrets with the programmer. That is the first point where technology can make a difference. Suppose trader B does the same, but puts his trading program into a faster computer. In that case, he would beat trader A in the speeds game. To counter trader B, trader A could upgrade to a faster computer. He could do more. He could place his computer closer to the stock exchange. A shorter wire would allow his computer to reach the exchange quicker. Now, trader A will win. That is exactly what some companies do, installing their computer systems right next to the stock exchange servers. Speed is important. When there is a piece of gold lying on the ground, the one who manages to get to it first will be able to take it. The winner takes all, the rest get nothing. But how often would you find a piece of gold lying there to be picked? Classical economics suggests that you won't find any gold lying there to be picked. Opportunities, if available, are most likely to be buried in a complex system, hidden under a large amount of data. Only sophisticated researchers would be able to find them. How to find patterns if they exist? This chart contains the price movements of FTSE 100 and a hypothetical stock. Can you see any patterns in it? For a start, do we know what we are looking for? Experts tell us that if you manage to find a relationship between two assets, there are ways to trade them in pairs and make money. So let's start to look for relationships. But that still leaves us with much to do. Stocks can relate to each other in different ways. For example, one stock might be leading the other by a few days. To check whether this is the case, we have to examine leading times of 1 day, 2 days, etc. Where do we stop? Their relationship could be more complicated than that. It may involve other factors such as dividends, times of the year, interest rates, etc. The number of possible combinations is numerous. We won't know which relationship stands until we examine it. Unfortunately, examination takes time. Computers may be fast, but they could easily be beaten by the sheer number of possible relations. What makes pattern finding even harder is that a rule may only work under certain situations. For example, A rule may only work in a bull market or when the interest rate is, say, above 2.4%. How are we going to discover such conditions? How are we going to find such magic numbers 2.4%? This is where clever computation methods may help. Such methods are studied in machine learning, one of the areas in artificial intelligence. What is computational finance about? It is about applying advanced computation methods to finance. What is advanced today may become basic knowledge tomorrow, so the field evolves over time. We have seen one example above. A trader may know where to look for patterns in the market, but there is a limit in how many places that he can afford the time to explore. This is where he needs help. A machine learning expert may know how to use computers to find patterns efficiently, but without the guidance of the trading expert, she could be searching in futile areas. Computers are fast, but the number of combinations is almost infinite. To increase her chance of finding useful patterns, computer experts need insights from trading experts to guide the search. By working together, the trader and the computing expert stand a better chance of finding patterns that neither of them can find on their own. Computational finance is about finding synergy between computation and finance research. By applying advanced methods, one aims to discover investment opportunities ahead of one's competitors.